You hit a major milestone. Your revenue is up, sales are climbing, and from the outside, your business is thriving. But when you look at the actual cash in the bank, your profit margins are shrinking, and you can't figure out why. You might turn to your standard bookkeeping or tax preparation files for answers. They show you exactly how much money came in and how much went out, which feels reassuring at first glance. But standard financial accounting has a major blind spot. It is built to tell you if the business is profitable overall. It is completely unequipped to tell you how or where specific operations are bleeding cash. You are left staring into a financial black box. Your fixed costs like rent, variable costs like raw materials, and semi-variable costs like utilities all blur together into a single, unhelpful line item on an income statement. Surviving this critical scaling phase means you have to stop relying solely on external reporting. You need a system of granular internal diagnostics to find the leaks before they sink the company. That diagnostic system is called cost accounting. It is a highly specific method designed to break down, assess, and control your production costs on a micro level. This matrix shows the difference. On the left, financial accounting prepares standardized reports for external stakeholders, following rigid FASB rules. On the right, cost accounting provides detailed insights strictly for internal management, creating a highly flexible custom reporting framework. This introduces the central trade-off of every accounting method: bespoke accuracy versus operational expediency. You are trading a simple, standardized process for a complex, labor-intensive one. Establishing this granular, three-dimensional visibility is a significant operational and financial investment, rather than a mere change in paperwork. It requires substantial resources to get the system off the ground and keep it running. Upgrading to a cost accounting system demands a significant, immediate influx of capital. The initial setup costs alone can be staggering for a growing business. You have to purchase and integrate specialized accounting software, and then hire highly skilled, specialized talent to run it. These auditors and accountants command premium salaries for their expertise. This chart plots accounting behaviors by cost and strategic value. Down in the bottom left, basic tax prep requires low effort and yields low operational insight. Getting high insight requires moving to the top right, which demands massive effort and high complexity. The prime example of this is activity-based costing, or ABC. ABC is a refined cost allocation method that maps precise labor and material costs to specific orders or departments based on the exact activities that consume resources. The expenses don't stop at implementation. Maintenance requires continuous training, and the framework is highly vulnerable to severe data entry fatigue. If your employees fail to cooperate with the strict new tracking protocols, the data becomes useless. Attempting to implement cost accounting without sufficient capital and staff bandwidth will drain your company's resources rather than optimize them. If you have the funding and team to build the system, operational benefits become immediately apparent. Managers can use this bespoke data to accurately evaluate the marginal productivity of individual employees. You can pull wage expenses directly from specific jobs or subdepartments to see exactly who is generating value and who is slowing down the line. You can also view this financial data from multiple angles to evaluate capital investment options. Because you aren't tethered to rigid external rules, you can analyze the specific returns on purchasing new equipment or expanding facilities using criteria that actually matter to your operations. But abandoning standardized rules introduces a hidden danger. Removing rigid frameworks invites uncertainty, cascading instability, and massive internal auditing risk into your decision-making process. Because uncertainty always equals risk, you have to counter it with vigorous, expensive internal reconciliation processes. You will spend significant time and money just verifying that your custom metrics are accurate. Bespoke flexibility is an incredible weapon, but only if you have the operational discipline to ensure the data is flawless. Without that discipline, the system becomes a massive liability. There is also a psychological trap in handing your management team hyper-granular daily cost data. Cost accounting allows managers to rapidly isolate and target expensive variable costs, like raw materials, and semi-variable costs, like equipment maintenance, for immediate reduction. This line graph shows exactly what happens when management targets those expenses. As variable costs are aggressively slashed, you see a sharp, highly visible spike in short-term profit margins. But this creates a dangerous behavioral incentive. The system encourages managers to prioritize cheap materials and reduced labor over long-term value creation. The long-term consequences of these cuts are severe. Relying on cheaper parts and stretched labor compromises your product quality, leading directly to customer dissatisfaction and permanent reputational damage. Cost accounting reports will often suggest cost reductions that look brilliant on paper today, but quietly sabotage the company's long-term survival. So how do you objectively determine if your business is ready to make this transition? What is your primary reporting goal? For investor reporting and tax compliance, stick with financial accounting. For internal optimization, ask if you have the capital for specialized software and dedicated talent. If no, hold off. If yes, you are ready to implement cost accounting. Lean, early-stage startups or simple service businesses without significant operational budgets must avoid this system entirely. For these smaller entities, cost accounting is an expensive, inaccurate distraction. It pulls critical focus and capital away from your most important objective, generating initial revenue. However, there is a threshold where this system becomes mandatory. Complex manufacturing, high-volume retail, and scaling companies managing sprawling internal departments outgrow standard bookkeeping. These complex operations absolutely rely on tracking granular past cost behaviors. They need that specific data to accurately predict future costs, set realistic budgets, and survive tight margins. For these large entities, the exorbitant upfront cost of software and talent is neutralized by the massive scale of their efficiency savings. Finding a 1% margin improvement across a global supply chain pays for the accounting department 10 times over. The value of cost accounting depends entirely on a specific variable: your company's capacity to wrangle this data and maintain the system's integrity over the long term. Standard financial accounting is designed to keep your business compliant and out of trouble, but cost accounting, when deployed at the right time in your growth cycle, provides the diagnostics required to protect your margins as you scale.